Welcome to this explainer. Today we are going to dive straight into the data behind the highly anticipated Bagmane Prime Office REIT IPO. We're cutting through all the market noise and looking directly at the analyst research to figure out if this massive real estate offering actually deserves a place in your portfolio. If you've been tracking Indian real estate investment trusts, you already know this is a big one. So let's get right into the numbers.
Okay, here's our roadmap for today. We'll look at the IPO snapshot, take a peek inside the asset portfolio, lay out the financial bull case, benchmark it against peer REITs, weigh the key investment risks, and finally deliver the final verdict. Let's get to it.
Section 1. The Bagmane IPO Snapshot.
Just look at this number. A massive 5,500 crore rupee issue size. This isn't just a small expansion. We are talking about a major market event. Now, this structure includes a 3,500 crore fresh issue alongside a 2,000 crore offer for sale. But here's what you really need to care about. Roughly 70% of the proceeds from that fresh issue are specifically earmarked to aggressively reduce debt. That means, right out of the gate, they're cleaning up the balance sheet.
So if you're an investor seeking income, here is the crucial point. A highly attractive 7 to 7.5% year-one implied yield. And that's assuming a price band of 95 to 100 rupees per unit. In our current market environment, a yield starting with a 7 is absolutely going to turn some heads. But as we know, a yield is really only as good as the underlying assets generating it.
Section 2. Inside the asset portfolio. The portfolio boasts a staggering 16.5 million square feet of Grade A campuses. And we aren't just talking about your average standalone buildings here. These are premium, LEED Gold and Platinum certified tech parks perfectly situated in the deep supply micro-markets of Bengaluru. Places like the Outer Ring Road, CV Raman Nagar, and Whitefield. It's premium, top-tier infrastructure built specifically for modern enterprises. Now, what is really fascinating here is how heavily anchored this real estate is by massive global players. A whopping 75 to 80% of the tenant base is made up of multinational corporations and global capability centers. We're talking marquee names: JP Morgan, Microsoft, Cognizant, and Texas Instruments. Having these guys on board provides substantial rent stability, mostly because these types of tenants sign long leases, and let's be real, they rarely ever default.
Section 3. The financial bull case.
First off, look at this operational efficiency. It's fantastic. They've got a staggering 93% committed occupancy with a brilliant tenant retention rate of over 90%. In the commercial real estate world, keeping your buildings full is literally half the battle, and Bagmane is absolutely winning it. It means their current cash flows are highly secure and predictable. Second, that strong multinational base we just looked at, it acts as a highly reliable moat. This is incredibly vital as global capability center demand, which is essentially offshore tech and operations hubs, structurally rises in India. India is the top GCC destination globally right now with record high leasing expected, and Bagmane is perfectly positioned to capture that exact wave of demand.
Third, and this brilliantly illustrates their growth engine, there's an embedded 12 to 15% mark-to-market upside. Basically, this means the current rents they're collecting are actually 12 to 15% lower than the going market rate today. So as old leases expire, they can hike the rent significantly. Combine that with guaranteed 4.5% annual contractual lease escalations, and you've got organic growth baked right into the math.
Fourth, the sponsor, Bagmane Developers, who are actually among the top 3 office developers in all of Bengaluru, offers a massive right of first offer pipeline. This gives the REIT the first right to acquire 6 to 8 million square feet of future, pre-built sponsor assets post-listing. It's a highly visible pipeline for inorganic growth over the next 3 years.
And finally, all of this robust operational data culminates in that healthy 7.0 to 7.5% year-one yield. But hey, a number in a vacuum doesn't mean much, right? We really have to see how it stacks up against the rest of the market.
Section 4. Benchmarking against peer REITs.
When you look at this data, Bagmane clearly stands out. It offers a 50 to 80 basis point yield premium over giants like Embassy and Mindspace, and it prices right in line with Brookfield. But look a little closer at the quality. Bagmane maintains the highest occupancy at 93%, and post-IPO, they're going to sit at a very comfortable loan-to-value ratio of 28 to 30%. This lower LTV gives them plenty of borrowing runway to make those accretive acquisitions we just talked about. Essentially, they're offering you more yield for a tighter, more occupied ship.
Section 5. Key investment risks. But, as in all investing, yield is inextricably linked to risk.
We need to brutally assess the structural vulnerabilities here to see how they temper the enthusiastic bull case we just laid out.
The absolute biggest risk here? It's geographical. Bagmane is a 100% single-city REIT. Unlike Embassy or Mindspace, which are spread out across India, Bagmane is entirely in Bengaluru. If Bengaluru's local IT leasing cycle slows, or if new local supply outpaces demand, and keep in mind there's about 15 million square feet of new supply incoming in the Outer Ring Road alone, that's a direct hit to your dividends. Add to that the tenant concentration. The top 10 tenants pay roughly 45 to 50% of the rent. If just one or two of these MNCs decide not to renew, the impact is highly material. Throw in rate sensitivity against a narrow bond spread of around 120 basis points, and the picture gets much more complex.
Section 6. The Final Verdict.
The final verdict derived from the analyst's data is to subscribe for a long-term horizon, meaning 3 to 5 years. But, and this is crucial, this is strictly conditional. It's only recommended if the final IPO pricing implies a yield at or above 7.0%. If the final price band pushes the yield below 7%, the recommendation downgrades to neutral, simply because that single-city risk is no longer adequately priced in.
Ultimately, what you're looking at is a massive balancing act. On one side of the scale, you have incredibly defensive, high-quality cash flows, top-tier occupancy, and a fantastic balance sheet with visible growth potential. On the flip side, you have the very real, structural threat of single-city exposure and heavy reliance on a handful of massive tech tenants.
So, as we wrap up this explainer, I want to leave you with this foundational question to weigh against your own investment strategy. Does a 7% yield adequately compensate you for taking on single-city concentration risk? The data is all laid out clearly right here, but how that risk actually fits into your broader portfolio, well, that's entirely up to you. Weigh your options, dive into the prospectus, and keep learning. Thanks for joining me on this explainer.